What if the thing you feared most about your investment wasn't the crash, but the moment you stopped thinking clearly because of it? What if the real threat to your financial future wasn't a Fed dot plot, but the four-letter word that sells more silver at a loss than any market force ever has? That word is panic, and this week, it was everywhere. There is a peculiar brutality in the way silver moves. It does not simply fall, it falls with the specific cruelty of an asset that had, just months prior, made ordinary people feel extraordinarily wise. Silver struck a nominal all-time high of approximately $121.62 per ounce in January of 2026. It trades near $64 today. That is a decline of nearly 47% from peak to present. And if you think that number has not reshaped the emotional landscape of hundreds of thousands of retail investors this week, you are not paying attention to human nature. The number on the screen does not merely inform, it accuses. And yet, and this is the thing that most of the commentary racing across financial media this week has conspicuously failed to say, the price of silver has not fallen because the thesis broke. It fell because a Federal Reserve dot plot, released Wednesday, June 17th, during the inaugural meeting of Chairman Kevin Warsh, showed 9 of 18 committee members projecting a rate hike before the end of 2026. The median year-end rate projection jumped from 3.4% in March to 3.8% in June. The dollar strengthened on the news, real yields ticked upward, and silver, which had already surrendered its monetary premium in stages since January, surrendered more of it on Wednesday afternoon, falling to a session low of $63.52 before recovering nearly 70% of that loss before Thursday's close. But let us begin, as intellectual honesty demands, with what actually happened on Wednesday and why the panic it produced, while understandable, is almost certainly a misreading of the signal. The June 2026 Fed dot plot included 18 dots for 2026, with 9 meeting participants projecting the year-end federal funds target range to be at or below the current 3.50% to 3.75% level, meaning the committee was exactly split between holding and hiking. What made this genuinely newsworthy was not the hold itself. A 97.4% probability of a hold at 3.50 to 3.75% had been assigned by CME FedWatch going into the meeting. The hold was priced. The dot plot was not. What was equally not priced, and what the market is still not fully metabolized, was the behavior of the chairman himself. Kevin Warsh did not participate in the dot plot, stating in his press conference that while he encouraged his colleagues to continue offering projections, I, however, have refrained from offering any projections of my own, consistent with my long-held views. Consider the architecture of that silence. 9 of his colleagues lean hawkish, 8 lean neutral or dovish, 1 projects a cut. The chair himself submits nothing, and in doing so, preserves more optionality than any single dot could express. Warsh also announced plans to form 5 task forces to review aspects of the Fed's monetary policy operations, communications, data sources, productivity, and the labor market, as well as the causes of inflation. He was not merely running a meeting, he was rewriting the institution. And in that rewriting, he left his own rate view deliberately, conspicuously, perhaps strategically, blank. Before you decide what to do with this information, there are 4 more layers to this story that almost no one is talking about, and they change everything. Stay with me. 5 types of silver investors exist in this market at this precise moment, and the type you identify with will determine whether you look back at June 2026 as the moment you made your most consequential financial mistake or your most composed financial decision. The first type sold on Wednesday, June 18th, the moment the spot price printed $66.99 and fell 1.36% on the session. They told themselves they were being disciplined. They were being emotional, which is precisely what discipline is not. The second type is refreshing their price application every 4 minutes, calculating the percentage distance between $64 and $121.62, and running the arithmetic on what recovery would require. They are torturing themselves with a number that tells them nothing useful about what happens next. The third type is buying impulsively at every dollar dip, mistaking activity for strategy. The fourth type has checked out entirely and is waiting for $100 before re-engaging. They will not re-engage at $100. They will re-engage at $115, 3 days before the next correction. And then there is the fifth type. This is the investor sitting quietly, not celebrating and not catastrophizing, reading the actual structural data that exists beneath the price, and making decisions calibrated to what that data says, rather than what the number on the screen makes them feel. That investor is rare. That investor, historically, is the one who profits most from precisely the kind of dislocation we are currently inside. What happened on Wednesday was not a structural revelation. Silver fell from $69.85 to $64 in the week of the FOMC meeting alone. But nothing in the dot plot altered the supply deficit. Nothing in Kevin Warsh's press conference changed China's industrial consumption trajectory. Nothing in the 9 hawkish projections reversed the fact that electric vehicles consume 67 to 79% more silver per vehicle than internal combustion cars, that solar photovoltaic manufacturing is deploying at volumes that even reduced per-panel silver intensity cannot offset, and that the global silver market is heading for its 6th consecutive annual supply deficit of 46.3 million ounces. The monetary ceiling moved on Wednesday. The industrial floor did not. Here is the question no one in silver commentary is asking loudly enough, and it may be the most important question in this entire market right now. If the hawkish case was so obvious, why did silver recover 70% of its Wednesday losses in the same session? Markets are not perfectly efficient, but they are not stupid either. When a metal drops to a session low on a major policy announcement and then recovers nearly 3/4 of that loss before the session closes, someone, an institutional someone, likely many institutional someones, is buying. And they are not buying because they failed to read the dot plot. They are buying because they read something behind the dot plot that the panic sellers did not stay in the room long enough to read. What I'm about to tell you about China is the single data point that almost no silver commentary this week has led with, and it is more consequential for your actual long-term position than anything the Fed said on Wednesday. Asterisk. China is now a major consumer, not a supplier of silver. This structural shift is being driven by a powerful acceleration in industrial demand, with silver's unique properties making it indispensable in the technologies reshaping the global economy. The world's largest industrial consumer of silver, the country that imposed a licensing regime on January 1st specifically because its domestic manufacturing sector needed more of the metal, is consuming silver at its highest rate since 2018, an 8-year high. Let that sit for a moment without narrative appended to it. An 8-year high in demand from the country that simultaneously restricted its own exports to preserve domestic supply. China's 2026 silver export controls effectively restricted 60 to 70% of global supply to domestic use through a licensing framework that replaced the previous quota system, a policy that mirrors rare earth tactics, prioritizing domestic industrial use over exports to strengthen geopolitical leverage. This is not a tariff subject to weekend summit negotiation. It is a structural policy reflecting the physical reality of what Chinese industry consumes. The automotive industry's shift toward electric vehicles is driving substantial increases in silver demand, with EV vehicles projected to overtake internal combustion vehicles as the primary source of automotive silver demand by 2027, accounting for 59% of the market by 2031. The Silver Institute projects that sectors like solar photovoltaics, electric vehicles, and data centers and artificial intelligence will be the primary drivers of silver demand through 2030. China's government looked at precisely this trajectory, recognized that the international market could not supply what its factories required without compromising domestic production, and built a wall around its reserves. That wall does not dissolve because 9 Fed committee members project a rate hike. The supply picture compounds the demand picture in ways that deserve more careful attention than the dot plot has permitted this week. Even with higher supply, the global market stayed in deficit for the 6th straight year. Silver's story in 2026 is one of tight supply, shifting demand, and rising importance. Solar photovoltaic manufacturers have indeed reduced silver consumption per unit, with demand from PV installations expected to fall to roughly 194 million ounces this year, marking a 7% year-on-year decline even as global solar capacity continues to expand by around 15%. Read that sentence twice. Less silver per panel, more panels. The efficiency gains are real. The volume expansion is larger. The deficit persists not because manufacturers failed to adapt, but because the scale of deployment has outrun the adaptation. You can reduce the silver per panel. You cannot reduce it fast enough to offset the absolute volume of panels being installed across every continent simultaneously. Now consider what Kevin Warsh actually did and did not do on Wednesday, because this is the part of the story that most sophisticated silver commentary is treating as a footnote rather than the lead. The dot plot this time may be the last one ever produced. Warsh himself said, "There will be a review about communications broadly, press conferences, dots, meetings, and the like," with his colleagues described as being very open about changes. The chief economist at EY Parthenon suggested this might be the last dot plot the market ever sees. Think carefully about what that means structurally. The instrument that just caused silver to drop $2.25 in a single session may be an instrument that the chairman of the Federal Reserve is actively preparing to eliminate. You are being asked to panic over a signaling mechanism that may not exist at the September meeting. And the chair's own position on rates remains, by his own deliberate design, formally unknown. Although Warsh has argued that supply shock inflation generally should be looked through when formulating policy, and has maintained that artificial intelligence will ultimately have a disinflationary impact on the economy as rising productivity eases the cost of goods and services, the man who runs the institution that sets the rate has explicitly declined to tell the market where he thinks rates are going. That is not ambiguity born of indecision. That is strategic optionality, preserved deliberately by a chairman who inherited an inflation problem substantially driven by a war in the Strait of Hormuz, and who recognizes that the inflation inputs may shift faster than any dot projection can track. If 3 of the 9 hawkish projections were premised on oil price assumptions that are now shifting downward following the Iran ceasefire framework, as Bank of America economist Aditya Bave has noted, then the apparent hawkish consensus of 9 is more fragile than the dot plot headline suggests. 9 of 18 is not consensus, it is a bare majority, and 3 members reconsidering at the September meeting does not require a macro revolution. It requires oil to normalize below $85 and core PCE to print in a direction that validates what the University of Michigan's final June consumer sentiment reading has already suggested, that one-year inflation expectations eased to 4.6% from 4.8% in May, with 5-year expectations falling from 3.9% to 3.4%. Both directionally correct, both moving before the strait formally reopens. If this channel has ever given you a single piece of analysis that helped you think more clearly, not just about silver, but about how markets actually work versus how they feel, hit that subscribe button right now. Because what I'm about to walk you through in part 3 is the framework that separates the investors who profit from this kind of volatility from the ones who fund those profits by selling at the wrong moment. The next binary event in this market is not a Fed meeting. It is Thursday, June 25th at 8:30 a.m. Eastern Time. 3 simultaneous data releases: May core PCE, the Fed's preferred inflation gauge, the final first quarter GDP reading, and initial jobless claims. Forecasters expect headline PCE to potentially touch 4.1%. If it prints at or below that expectation, the 9 hawkish dots look aggressive relative to the data. The fragile consensus cracks before it ever held. Silver's monetary ceiling, which was lowered on Wednesday, begins reasserting upward pressure before the summer is over. If it prints above, the rate hike case firms, dollar strength continues, and silver's near-term ceiling remains where the dot plot put it. This is what the market is doing right now. It is not panicking. It is waiting for Thursday's data. The investors refreshing their price apps every 4 minutes are not participating in that wait. They are suffering through it. And suffering and waiting are not the same activity. Peter Brandt predicted the January 2026 silver crash before it happened. He was right when most were wrong. He was specific when most were vague. And then, after the crash he had predicted played out, he changed his view. Brandt turned bullish after the crash, writing, "2026 is not 2011. In my mind, the 2011 rally was destined to return back to the teens." The man who called the crash correctly is now saying the conditions that made 2011's correction cascade into a multi-year bear market do not exist in 2026. That is not a casual statement from a casual observer. It is worth understanding what those conditions actually were, because the comparison reveals everything about why the current correction is structurally different from the one that haunts silver investors' nightmares. What I'm about to tell you explains why the investors who panicked in 2011 and waited 8 years to be proven right are likely making the exact same mistake right now, and why the floor beneath this market is fundamentally different from anything silver has stood on in the modern era. In 2011, the Federal Reserve was tightening, real rates were rising, the monetary response to the 2008 financial crisis was being actively unwound, silver's tailwinds were not pausing, they were gone. The industrial demand base that now anchors silver's floor simply did not exist at the scale it exists today. In 2014, only 11% of silver industrial demand came from the solar photovoltaic sector. By 2024, that share had more than doubled to 29%. The EV revolution was a concept paper, not a production reality. AI data centers were not consuming silver at meaningful scale. 5G infrastructure did not exist. China's export controls restricting silver to domestic industry did not exist. The Silver Institute documented a structural supply deficit for each of the past 4 years through 2024, with mine production reaching roughly 844 million ounces in 2024 against total demand of approximately 1,219 million ounces, a shortfall of approximately 195 million troy ounces, marking the fourth consecutive annual deficit. In 2011, when silver fell from $49 to the teens, it fell into a market without a structural industrial floor. Today, it is falling into the deepest industrial demand base in the metal's modern history, and it is doing so while a sixth consecutive supply deficit actively draws down above-ground stockpiles. Above-ground silver inventories have decreased 35% since 2015, while industrial demand has increased 40%. The floor is not a sentiment floor, not a narrative floor, not a people believe silver is important floor. It is a physical floor, built of solar modules, EV power electronics, 5G infrastructure, and AI data centers that will not stop consuming silver because Kevin Warsh's colleagues project a rate hike. You should not be panicking if, when you purchase silver, you understood what you were buying. If you bought because the supply deficit was structural and 6 years deep, if you bought because approximately 70% of silver supply is a byproduct of other metals mining and cannot easily expand to meet demand, if you bought because sovereign accumulation programs in Russia and India were acquiring silver for the first time in the modern era, if you bought because the gold-silver ratio at current levels implies significant undervaluation relative to gold, if you bought because Peter Brandt, who called the crash, turned bullish and explicitly stated the structural conditions that produced a multi-year bear market after 2011 do not apply today. If you bought because Kevin Warsh submitted no dot and left his own position on rates formally open. If you bought because global physical investment is forecast to increase about 20% to 227 million ounces, reaching a 3-year high, with Western investors returning after several weak years. If those were your reasons, any meaningful combination of them, then nothing that occurred on Wednesday, June 17th changed those reasons. The dot plot adjusted the near-term monetary ceiling. It did not touch the industrial floor. It did not eliminate the supply deficit. It did not reverse China's 8-year high consumption. It did not reopen the mines that cannot expand output faster than demand is growing. The 9 hawkish dots belong to 18 people whose views are premised on inflation inputs that may shift materially before September. The chair's own view is unknown by deliberate design, and the chair himself has indicated that the dot plot itself may not survive the communications review he has initiated. You should, however, be urgently reassessing if the entirety of your thesis was the price chart, the headline number, a $300 target from someone on the internet, and the intoxicating sensation of watching a number go up. Not because the structural thesis is wrong, it isn't, but because you never actually held the structural thesis. You held a price chart. Price charts correct. They correct sharply, sometimes painfully, always at the moment that feels least opportune. The dot plot did not create your problem. The absence of a thesis beneath the chart did. The distinction between those two investors is not intelligence. It is not financial sophistication. It is simply whether the reason you bought silver was something that changes with a Fed press conference or something that compounds across years, regardless of what any single meeting produces. The dot plot changes month to month. The 6th consecutive annual supply deficit of 46.3 million ounces does not. China's export restrictions do not reverse in a weekend. The EV transition does not pause for a hawkish dot. The AI data centers consuming silver in their cooling and electrical systems do not power down because the median rate projection moved 40 basis points. Robert Kiyosaki posted on June 20th that silver charts are positioned for what he described as a massive future rise, and that he is waiting to buy on a confirmed reversal. He was not instructing anyone to buy at $64. He was instructing everyone to stop allowing a falling price to make their decisions for them. That is the only instruction that matters this weekend. Not the session low, not the percentage decline from January. None of those numbers tell you whether the thesis you purchased is still intact. They only tell you that a paper market, operating in a thin post-FOMC holiday session on Juneteenth, with widened bid-ask spreads and thinned order books, expressed maximum bearish sentiment for approximately 2 hours before recovering nearly 3/4 of the loss before Thursday's close. Panic is a response to a threat you have not yet understood. Understanding the threat does not make it disappear. It does not guarantee a particular price outcome or a specific timeline. It does not replace the discomfort of watching a number you care about move in a direction you did not choose. But it does mean you respond to the market rather than react to it. It means the decisions you make this weekend are made by the analytical part of your mind, not the part that calculates percentage losses at 4 in the morning. And historically, in every commodity cycle that has ever existed, the investors who respond rather than react are the ones who are still positioned when the fundamental thesis they identified eventually, structurally, inevitably, asserts itself in price. Thursday, June 25th at 8:30 a.m. Eastern. Core PCE, final Q1 GDP, initial jobless claims, 3 simultaneous prints that will either validate the 9-dot hawkish consensus or begin the process of fracturing it. That is the next binary event. Until then, the only question worth answering is the one you should have answered before you bought. Do you understand what you own, or do you only understand what it costs? Drop your honest answer in the comments below. Are you a Type 5 investor who holds the structural thesis, or do you need to build one before Thursday morning? Your answer will tell you more about your next move than any price chart will. The silver market will do what markets do. It will be irrational in the short term, occasionally brutal, and ultimately governed by physics, the physical reality of how much of this metal the world needs, how much the world can produce, and the arithmetic gap between those two numbers that no Fed dot plot has ever been able to close. That gap is real. It is documented. It is 6 years deep and widening, and it will not ask for your panic or your permission before it reasserts itself in price. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history